So you are you're in a virtual financial consultation session with me. What would we be talking about? So of course we will start off with your priorities. With me, I want to get to know my clients to understand them better. I want to understand more about their priorities, their goals in life, their values, their history, their spending mindset, educational mindset as to their children, so that we can plan a good financial plan for them. So it's not supposed to be long. You can do maybe a quick 20 minutes, 30 minutes of the time. Try to understand what are the priorities. Let's look at this mindset. If you are not going to die soon, then most probably you will be retiring, right? Either way, you know that you're either dying or retiring, so you can already prepare. If you have a child, or if you're planning to have one, if you're planning to have a family in the future, then definitely you would want the child to get educated, right? Educated in a nice university, a university you hold in good regard. So that case, you need to prepare a budget for that. So if you are preparing for the education of your child, you should be putting in money now already. So if you look at it, either you retire or you die, and if you have a kid or plan to have a family, then you will have to prepare for an educational fund. So if you have those three things that you can prepare for, what can you not prepare for? Uncertainties. You cannot prepare for things that are not certain to happen. If you look at data, of course, at one point in time, you will get some sort of a disease, some sort of an accident. So if data tells you that there's a chance you will do that, then that's something you can prepare. But if you look at it from the other lens, you can just think that it will not happen, and that's good for you. But then again, we're talking about managing your risks and preparing for your future, achieving your financial goals with my. So let's talk about your plans when you die. If you die today, who would be most impacted? Your loved ones, your children, your family. Everyone who's relying on you financially would be impacted by what's happening. Like you suddenly died. And all the memories. So how do you prepare for that? The best way, of course, is to make sure that you have your properties well prepared for through an estate plan. And then you have set up different funds for your family, like an educational fund for your child. You have secured a home already for them to stay. Your debts are already paid. And there's enough money to sustain them for at least the near future when they're trying to adjust because of your loss. So if you don't have money enough for that, then you should be preparing for that. But what if I told you that there's an easy way to do that? That's why insurance is there. So instead of you putting in the money to save for when that time happens, what you need to do now is just pay the monthly premiums. And those monthly premiums can translate to a huge sum of money depending on the premium. Let's say millions of pesos. These millions of pesos can now provide for the next 5 to 10 years of living, maybe pay off your debts if you suddenly die, pay off the mortgage of your house or your car so that your family can have that car and house for themselves when you die. It will not be foreclosed by the bank. And once those are in place, then good. I'd say you have secured your loved ones. You will be feeling well and secure knowing that if something happens to you today, you know that they will be taken care of. Next, if you will not be dying in the near future, then definitely you will be retiring, right? So if you retire, how much would you need to spend after you retire? If you're planning now, saving money in the long term, it's actually impacted by inflation. If you're saving X amount of money right now, that money, the value of that money degrades through time. And the only way to contradict the inflation of money is to actually invest it. You should invest your money in a vehicle that can earn you at least the inflation rate. On average, that would be around 4 to 6% annually. So you would want an investment which beats inflation at the very least, which is 4 to 6%. So here, if you're investing and accumulating your money, then soon enough, you will accumulate a retirement. So how does an insurance plan work to help you get your retirement plan? If it's just purely insurance, we don't get the same. We just get the protection that if something happens to you, you're the one who's something. But if, for instance, you retire, you won't really benefit much from it. However, if you invest in a VUL, such as if you invest in an insurance plan with an investment portion, an investment component, then you can prepare for your retirement fund if nothing happens to you right now. But it's either you die early or you retire. In the case that you die early, you get your insurance premiums paying. You're paying your insurance premiums for that event. And in case you didn't die early and you retired, then what happens now is the funds that are accumulated from your premium can now be withdrawn to serve as your retirement fund or any other purpose that you would want it to would want to use it for. In this case, is VUL a good investment plan? It is not. I would tell you if your main purpose is to invest, then an insurance plan is not the way to go. There are other means and methods to actually invest, but VUL is not that. When you are buying insurance, you're buying the protection. And when you're buying a VUL, an insurance with a protection coverage, when you're buying a VUL, an insurance with investment coverage, then you are buying the protection, and at the same time, you get to save. You get a return of your money maybe after 10, 20 years, or you can even grow that money bigger than that. So the only difference is that if you're paying insurance only, it has more premium, but the money will be lost. In accounting parlance, we call this expense. Expense, it's a cash outflow. There is a possibility to get an asset, which is the return of the insurance premiums through the for when you die, getting the sum assured. But that's it. But with the viewer, you get to have money saved up for that purpose. The next would be it's not about retirement, it's not about death. Now let's talk about education. No? When you have a family, then definitely there's a high chance you will have children. And if you already have children, there's a high chance they will be going to high school and college. So if you know that these things are going to happen, why not prepare now? So how do you prepare for that? By creating savings specifically for that purpose, which is to pay up the tuition expenses of your child or your children. So how does an investment portion of the BUL serve? Just the same with the retirement fund, the investment component of your BUL can also be used as an education plan. However, since there's a more compressed timeline when we are trying to accumulate for the education fund of your children, then you can expect you would have to invest more in the meantime so that we can accumulate more. But what's the good thing about investing more is that when you use it in terms of creating a VUL, the more premium you pay, the more protection you get. And at the same time, the more premium you pay, the more savings or fund value that you accumulate. And the next product that I'll be talking about is not more of the insurance side, but more of investment heavy component. I'm not naming these, but there's this product wherein you can invest for premiums, have a limited pay plan, and then accumulate your fund value so that you can have an educational fund just in time for college of your child. So that's one. And then if we're talking about retirement, we're talking about education. I would say the last I'd be talking about for now, I'd say what I'd be talking next would be about critical illness. Let's say you can predict education, you can predict whether you will retire or you will die. But critical illness, you can live long and not have critical illness. You can live long and be healthy. But yeah, it's something you can prepare. It's like a good to have. And if it really happens, it's really good to have. So let's imagine that you save 5,000 a month. That's 60,000 a year. That's 600,000 in 10 years. And suppose in the 10-year period, you were healthy, but at the 10th year exactly, you got critically ill. You got diagnosed for cancer, for instance. Terminal cancer. And you would need at least 1 million pesos for that. Or you would need at least 2 million pesos for that. So, what now would you do? So the 600,000 you have, you will spend it all for the hospital bills, and you will still be negative by a few hundred thousand, or maybe a million or so. So the good thing about Aviva is that it's got coverage as well for critical illness. Just imagine this: if you die, you got coverage. You will be paid a certain sum. If you didn't die, you will retire. Then you can withdraw the fund value that accumulated with your VUL. And if you have a child, you can use that fund as well to fund the education of your child. And if you got critical ill, then still there's a separate coverage that is outside the fund value that will be given to you, a sum that will be given to you, so that you can pay your hospital bills and hopefully survive the critical illness. So there's a lot of things that you can do with the VUL. Another thing that you can do is, for instance, you will buy property. You will buy a condominium. You will buy a house and lot. And your bank requires you to have property insurance. We call this the mortgage redemption insurance. What is it? If you suddenly die, the bank now has no choice but to forgo of your loan, because you will not be held responsible already. They will just they will have to file against your estate, but if your estate is not enough, your amana is not enough, then what would happen is the bank will be at a loss. So what is the solution to this by the bank? The bank now requires for a mortgage redemption insurance. In which case, if you die, essentially you are insured, and the amount that will be received by the bank is equal to the amount that you loan to the bank, the amount of the property, or at least the loan that you paid for. So, what can you do? You can set up a VUL and then say that, apply that to the bank, saying this VUL is now my life insurance. You are now my beneficiary, bank. If I die, then this VUL pay for the property, for my loan. But what's the difference about getting a VUL versus a specific MRI from the bank? A mortgage redemption insurance is just like traditional insurance. It's insurance expense. You just pay in the cash, you get protected, but there's no fund that's being accumulated. But if you invested in a VUL, what would happen now is that you can finish off this property. Say it's 10 million. You paid it off. Now the VUL comes back to you. It becomes fully owned by you. The beneficiary is you. Now the next property you will apply for, you can then use again this VUL. So you see the difference? In this VUL, you can use the very same VUL with the accumulated fund value to actually take out another loan. So the money that you paid for as MRI or mortgage redemption insurance premiums is now useful for another property. You didn't really lose that. You had funds accumulated for that. So that's the benefit of using a fund VUL as a mortgage redemption insurance. So there's a lot of benefits as well in the tax code as to insurance. If, for instance, you're trying to minimize your taxes, if ever you really die right now, managing your estate, the best way is to get an insurance plan. Get a high sum assured. Let's say 50 million, 100 million. And the proceeds of life insurance is exempt from taxation. So at least that part. But the fund value, that's another issue. You will have to pay taxes for the gains you accumulated for the fund value. But for the life insurance proceeds to sum assured, you get tax-free income once you die for your family. So how does this help you in the long term? So let's say you have an ancestral house worth 10 million. It's where you grew up. It's where your parents grew up, your ancestors grew up, and you don't want to give it up. And it's been customary for your family to have the eldest son inherit the house. Now, what will you do if you've got 5 children and that only that ancestral house is a property? How can you distribute the property? Your 5 children have their own families already. They want a share of the pie, and you want to give that to them without sacrificing, without partitioning the house. The solution is life insurance. Sum assured equal to the amount of the property, or I might say in this case, 4 times the amount of the property. Let's say you want the eldest son to inherit the whole of the house and it's worth 10 million. Then in order to match that, you have to get another 40 million worth of sum assured for each of the other children. This way, you can have the eldest son inherit 10 million worth of property, and the proceeds of the life insurance for the rest of your children will be paying 10 million each. 10 million for you, for you, for you, and for you. And that way, you can make sure that when you die, your children are not fighting for who will get what, how much will be gotten by who, because there is enough coverage for your life, then they can get an equal partition of what you want them to pay out. So we talk about estate planning. There is this called legitim, wherein you will have to pay a minimum amount to your heirs. Because if you don't follow that, then it will be void, and the other heirs can actually complain in the court saying they didn't get what they were due under the law. So these things we will be tackling if ever you wanted to discuss. So these things are what drives me to actually help people get their insurance plans. And insurance can be helpful not just to the rich for estate planning, but also to those working professionals, even to fresh grads who are just starting out. I'd say it's helpful for everyone. It's a product that is worth advocating for. And so I want you to have your questions lined up in the comments below. Ask me questions. How is it benefiting you? What are the products that can benefit you? But of course, at the end of the day, it's up to you. What's your priorities? What's your plans? I want to know those So if you schedule an appointment with me, schedule a session with me, and you want to plan out your finances, we will talk about maybe 60/30/20, 70/30. We'll talk about investments, mutual funds. We can talk about expense tracking, savings, mindset, four quadrants, everything that's under the sun. If you have questions, I will be able to answer them. But ultimately, I want to ask your goals, your priorities. Your position right now is the most important thing. You don't need to be rich. You just need to start. You just need to know that if you are insured, you have more capacity to do more and accumulate more. Also, just want to emphasize on the critical illness part. If you are critically ill, if for instance you are really saving up and you have all the money in the bank, this is a typical bank versus VUL approach wherein you save 5,000 in the bank, you save 5,000 in premiums every month. 60,000 in the bank gives you 60,000, while 60,000 in premiums gives you millions of coverage. And if really nothing happens, you still get your fund value if it's a VUL. So I want you to reach out to me to understand more about VULs. And this is how it looks like when we are in a cafe discussing. And of course, it will not be in English. But I'm communicating this. I'm thinking of reaching out to other our fellow countrymen, not just in the Luzon area, but of course to others in Mindanao and Visayas areas. I hope you would understand more about what I'm talking about because I think English is more or less the universal go-to language here in the Philippines, where everyone can understand. So if you have questions, just reach out to me. I hope this video serves you purpose. If this added value to you, please comment specifically on the comment box. What are the other things that you would want me to make a video on, make content on, so that I can create them specifically just for you. So I'm Carl. I'm a CPA, Juris Doctor. Hopefully, I'm lawyer by next year. Help me. And also, I am a dedicated financial advisor, and this will be my career moving forward after I transition from my full-time job. So help me guys to make it into this full-time job at some point later. But for now, let me intro you one by one, family by family, fresh grad, working professional, every person, one person at a time. Thank you so much. Have a great day.